Hello and welcome once again to the Capital Spreads weekly update. I'm again joined by our esteemed colleague Bill Hubard, who's managed to make it in today. Thank you very much for joining us again. I'll start off with the most obvious question. We've obviously had a lot of central bank action out the United States with the QE, the Bank of Japan yesterday, ECB a few weeks ago guaranteeing Eurozone bonds. Can this go on, and where can we actually expect the banks to go from here?
Well, I think it will continue, and I think the interesting thing that we've seen with those three banks' decisions, we have seen the focus go now to bankers, right? Whether it be central banks or regular banks, away from the politicians. And I think what we've seen last week and this week also seemed like for the first time, maybe since Lehman Brothers 4 years ago, the markets are now moving on, quote, economic fundamentals, which were really not looked at per se.
Okay. In terms of the Chinese PMI, obviously many people were pointing that out yesterday as well as being negative for the 11th straight time. How do you view the Chinese data, and what do you think how the Chinese can play into the Eurozone problems we have at the moment?
Well, I think what we're seeing with China, we're seeing, I'm not looking at it as being a hard landing. I think we're seeing an economic slowdown, a contagion. And I think one of the things maybe why people are focused on even more is whether we want to say start of this year or start of last year, everybody said, well, we're really not concerned about what's happening in the Eurozone or the US. Our good friends in China will bail us out, and all of a sudden, we're not seeing that. But also, again, I have a real problem when we say a slowdown in the economy that probably, unfortunately, may only grow at 7% for this year. And I think one of the things where people may be missing it, okay, and the current Chinese government, I think, what do they have? Elections or appointments every 10 years. Well, 10 years ago, when the current government started, they said, we're one government, but with two currencies. And of course, the renminbi is not convertible, but the Hong Kong dollar is convertible. Of course, it's paid to the dollar. And I think one of the things that again, our listeners or our viewers have to realize when something goes up and down, it could be for a peripheral reason. And one of the things with the strength of dollar yen. Remember, dollar yen was like 125 5 years ago. It's now 75, and most people feel it's 75 heading to 70. So the Chinese are being inadvertently affected by the dollar yen relationship with the dollar Hong Kong dollar.
Okay. In terms of the Spanish situation at the moment, bailout or no bailout?
Well, I think the market feeling much better, hence the reason the auction went fairly well today, feeling that whether it's pride or whatever, I think we're very close to a decision being made by the Spanish, and I think that will be a positive.
So you don't think they're going to ask for a bailout anytime
soon? No, I think they will. I think they will do whatever needs to be done. But, excuse me, we may have discussed this before. Here's where I have a problem, okay? When you've got a slowing global economy, you've got unemployment, especially in Spain, whether it's 25, 30, 35, or 40, depending on who you believe. Where is the government going to get revenues? We're going to have the same problem here, okay? Well, I think the average wage increase is 1.6%, albeit inflation is 2.5. So, you're going to have reduced revenues, okay? Which, if you have austerity, that sort of compounds it. So that's a question where I think there's some protest plan in Spain, but I think it will be a question that we will see the Spanish government apply, or whatever term you want to use, for some kind of bailout. And the market believes that, hence the reason ECB would not have made the decision that they did. And I think what we're hoping for is that Spain asks for the bailout, it improves the market, and on a peripheral basis, it helps the Italians.
Okay. And just one other point that I keep pointing you out on, you've mentioned a few times before, you're obviously very bearish euro dollar. You've been for a while.
Yes.
Long term, that is. Since
yes.
we talked about this a few weeks ago, it's gone nothing but north.
Yes.
How do you feel?
We covered our short positions at the 123.50, 124.88. Okay. We have been net short now above 130, 180. Okay. I'm a member. I'm not a member of the school, and I know there's still a number of people out there that feel 134 to 138 by the end of this year, 138 by the end of next year. My feeling is I'm in the 116, 118 level for this time next year. I just think, and we saw this today with the PMIs, there are some major structural problems now, which the ECB now will be looking at from a fundamental standpoint. I do expect, both here in the UK, I expect another 50 billion QE on the 8th of November when the bank meets, and I'm expecting another 25 basis points. And I mean, I think we saw it today. You're seeing massive selling. You know, the market, like we all know, either overbought or oversold. The market overbought the euro. And now we're seeing, you know, whether it be 130, 129.50, 128. Now, the thing where it's being, again, difficult is we got option. We got futures rollover. And of course, at the end of next week, we have the end of a quarter. So we're seeing people taking very, very heavy profits. It'll be interesting to see what the CFTC data says. But as I say, I'm negative the euro, I'm negative sterling, not as much because of euro sterling. I'm paying profits in gold, in silver, platinum, and palladium. On a net buying basis, I continue to buy 10-year treasuries, bunds, and gilts.
So you're playing it safe for the moment?
Yes, very much so, yeah. I mean, if that's where the play is, you can't push on a string.
Sure. Thanks very much for that, Bill.
Thank you.
Thanks very much for joining us. Feel free to join us again. And as usual, if you have any feedback, it's media@capitalspreads.com. Thank you.